Today's video is very important because we are not discussing indicators, entries, or signals. We are discussing how the market manipulates traders. Most traders can identify higher highs and higher lows, but very few understand why price pulls back, why zones break, and why the market suddenly continues. In this video, I'll explain inducement using this real chart, step by step, from left to right. No imagination, no over-labeling, only price action and institutional logic. If you understand this example completely, you will stop forcing trades and start understanding what the market is actually doing. Let's start from the left side of the chart. The first thing we see is clear bullish market structure. Price creates a higher high, then pulls back and forms a higher low. Then again, price pushes upward and creates another higher high. This sequence repeats. Higher highs and higher lows are not random. They clearly tell us that buyers are in control. This is very important because inducement does not work in isolation. Inducement only works inside a trend. So at this stage, we are not thinking about reversals. We are not looking for sells. Our mindset is simple. The market is bullish. Any pullback is suspicious. Manipulation is more likely than reversal. Now price pulls back into the first visible demand zone. This is where most retail traders feel confident. They see bullish structure, a clear demand zone, a healthy pullback. So naturally, many traders buy here. Their stop losses are placed just below the demand zone. From a retail perspective, this makes sense. But the market does not move to reward what looks obvious. Instead of respecting this demand cleanly, price pushes slightly below the zone. This single move changes the emotional state of traders. Now this is where most traders make a mistake. They see price break below demand and immediately think, demand failed, trend is weakening, reversal is coming. But this interpretation is incomplete. Let's slow down and analyze price behavior. After breaking the demand, price does not collapse. There is no strong bearish continuation. Structure is not fully broken. This tells us something very important. This move is not a genuine bearish shift. This is a liquidity sweep. Smart money pushes price below demand to trigger stop losses of buyers, force emotional selling, collect sell-side liquidity. Retail traders panic and exit. Smart money buys those orders. This is not weakness. This is intentional manipulation. After sweeping liquidity below the first demand, price moves into a deeper demand zone. This is where stronger institutional orders are waiting. Why does smart money do this? Because large players cannot buy at obvious levels. They need liquidity. Retail traders provide that liquidity through stop losses, fear, emotional exits. By breaking the first demand, the market creates fear. By reaching deeper demand, smart money gets better prices. This entire process happens before inducement. And this is very important. Inducement does not start the manipulation. Inducement comes after liquidity is already taken once. Now focus carefully on what happens next. Price moves up again from the deeper demand zone. Structure starts to look bullish again. Confidence slowly returns. Traders start thinking, okay, trend is back. The dip is over. Then price pulls back again, and this pullback is marked as inducement. This inducement is very specific. It happens after bullish structure, after liquidity sweep, after smart money positions itself. This pullback is designed to scare late buyers, encourage sellers, build fresh stop losses below. This is why inducement is dangerous. It looks like a reversal, a weak market, loss of momentum. But in reality, it is a trap. Now comes the confirmation. Once inducement completes, price reacts strongly and decisively. There is no hesitation. There is no sideways movement. We see strong bullish candles, clear displacement, break of previous highs. This reaction tells us one thing: liquidity has been collected. Sellers are trapped. Smart money is executing the real move. If this pullback was a true reversal, price would struggle. But it doesn't. It expands. So let's summarize this chart properly. Market structure was bullish. First demand break was liquidity manipulation. Deeper demand was institutional accumulation. Inducement was a deliberate trap. Continuation confirmed smart money intent. Remember this clearly. Not every demand break is bearish. Not every pullback is inducement. Inducement is manipulation inside a trend. If you wait for inducement instead of reacting emotionally, you stop trading like the crowd and start thinking like smart money. Let's come on a real chart and read price step by step. Now, first of all, I want you to forget indicators, forget entries, and forget targets. Here, we are only reading price behavior. On the left side of the chart, price is clearly moving in a bullish environment. We can see higher highs and higher lows forming gradually, which tells us that the higher time frame intention is bullish. But bullish does not mean price will only move up. Bullish markets still need liquidity, and that liquidity comes from traders. Now focus on this internal structure. Price creates a small bullish leg and then pauses. It forms a temporary support. This support looks real. It looks like demand. It looks like continuation. Retail traders enter buys here. Stops go just below this structure. Late buyers add positions. This area is not real demand. This is an inducement area. Inducement must look real, otherwise it will not work. Now pay attention to the next move. Instead of continuing up, price breaks below this inducement structure. This is not a mistake by the market. This is not manipulation for fun. This move is done to trigger stop losses, remove weak buyers, create sell pressure from trapped traders. This is exactly where emotions change from confidence to fear. As price moves lower, many traders think the trend is reversing, but that assumption is wrong. This move is not a trend change. This is liquidity collection. Price is now moving toward a deeper area where smart money is actually interested. This is the key lesson from this real chart. Inducement is not there to give you an entry. Inducement is there to trick you into entering early. If you buy at inducement, you become liquidity. If you wait for inducement to complete, you trade with smart money. That is how inducement works on a real chart, not in theory, not in drawings, but in live market behavior.